Hey everyone, welcome back to Corporate Decoder, the place where we find out if companies are painting a pretty picture or hiding something nasty. Today we're diving into Sensient Technologies' annual report, Think Colors and Flavors, but is their financial performance as vibrant as their products? Let's find out. Sensient Technologies, a big name in colors, flavors, and specialty ingredients, had a pretty good year. Revenue hit about $1.6 billion and they made $2.94 per share. But hold on, not everything is as it seems. There were some restructuring costs that kind of muddied the water. Now, before we get too deep, remember this report has forward-looking statements. These are like guesses about the future. The company is basically saying, hey, we think things will go this way, but you never know. Lots of things could change. The company uses some financial measures that aren't exactly by the book. They are called non-GAAP measures. It's like having a special recipe. They take out some ingredients to show a slightly different picture. We will try to decode these as we go. Sensient makes all sorts of things, colors for food and drinks, flavors to make things taste better, and ingredients for medicines and cosmetics. They operate in a bunch of countries with their main offices in Milwaukee. They bought a natural colors business in Turkey a couple of years ago for $23.3 million. Basically, they're trying to own more of the natural color market. They sold off their yogurt fruit preparation product line a while back and they got a small payment of $2.5 million, so it looks like the company isn't afraid to drop a product line. The Flavors and Extracts Group makes flavorings for the food, beverage, and personal care industries. They're also big in natural ingredients like dehydrated onion and garlic. It sounds simple, but these guys are behind a lot of what we taste every day. The Color Group makes colors for just about everything from food and drinks to cosmetics and even industrial stuff. They call themselves the biggest maker of certified food colors. The Asia Pacific Group sells Sensient's products all over the Pacific region. It's kind of their way of saying they are serious about doing business in Asia. Corporate mostly deals with managing the company and support from their headquarters. This part of the company includes the costs, like restructuring and other charges, and the portfolio optimization plan costs. They've got a whole team working on research and development, quality control, etc. They want to make better stuff and make sure it's safe and meets all the rules. Sensient employs over 4,000 people worldwide. The company focuses on finding good people, training them, and keeping them happy. Food safety is crucial, of course. They say they have got a robust program to prevent any contamination and ensure their products are safe, and they are audited very thoroughly. The products they make are heavily regulated. They seem to be on top of it and they follow all the rules in the US, Europe, and everywhere else they do business. Like every company, they have got risks. Competition is intense. Lots of other companies are trying to do what they do, so let's see what they say are risks. They're worried about competition eating into their sales and profits. Makes sense in a crowded market. Bad economies can hurt their business. Also, the conflict in Ukraine could mess with their supply of sunflower oil, and in the Middle East. Chain problems at their factories, like equipment breaking down or accidents, could stop them from making products and hurt their profits. They also depend on their customers doing well. If their customers, the companies that use Sensient's ingredients, struggle, it could also mean less business for Sensient. If they lose a big customer in one area or product line, their numbers could take a hit. They say tariffs, trade disputes, and other trade barriers are a risk and could make their costs higher or make it harder to sell their products. Their customers are merging and getting bigger. This means the customers have more power to negotiate lower prices, which can reduce profits. Changing consumer preferences, changing regulations like possible bans on certain food colors, and changing technologies are risks and could affect what they sell. They need to keep costs under control, otherwise they won't make as much money. They mentioned a plan to cut costs, which includes closing some facilities. These types of actions may result in a deterioration of employee relations. A disruption in their supply chain, getting raw materials, could be a problem too. It could cost them more to get what they need. If they mess up managing their inventories, having too much or not enough, it could hurt their performance. Volatile costs for raw materials, energy, labor, and transportation could reduce their profitability. If their customers go bankrupt or have financial problems, it may reduce ability to buy, to accept price increases, or to pay for products. Currency exchange rates going up and down can hurt their results, especially since they do business in lots of countries. Doing business in other countries has its own risks, like political instability, security concerns, and changing regulations. More and more people are focused on environmental, social, and governance issues, or ESG. This could mean they have to spend more money to meet certain standards. Bad stuff like natural disasters or big world events could also affect their numbers. They could get sued or have product recalls, which could hurt their reputation and profits. If they break any laws or regulations, whether it's about the environment, food safety, or anything else, they could face fines or other penalties. Bribery and corruption are no-nos everywhere they do business. Breaking those rules could mean big trouble, expensive investigations, and penalties. And tax laws change, and that could expose them to more taxes and hurt their bottom line. Losing key employees, especially those with access to trade secrets and confidential information, may have access to the company's trade secrets. They might buy or sell businesses in the future, and these deals could come with challenges or unexpected problems. If their IT systems fail or get hacked, it could really mess things up and hurt their competitiveness. Protecting their ideas, formulas, and other intellectual property is a key aspect for their performance. It is important to understand how a company manages its cybersecurity. It seems to be very important to them, and they take many measurements. No risk from identified cybersecurity threats, including as a result of any previous cybersecurity incidents, have materially affected the company. It is worth paying attention to in the future. They own some offices and plants, and they lease others. They seem to think all their facilities are in good shape. They're involved in some legal stuff. Not much detail here. Let's dig into the numbers. Sales were up and profits were up a bit thanks to higher volumes and prices. The flavors and extracts segment did well but had a loss from the natural ingredients business unit. The higher operating income in flavors, extracts, and flavor ingredients was primarily due to lower raw material costs. The color segment had a sales increase mostly from higher volumes and prices in food and pharmaceutical colors and personal care, but operating income was up in personal care and food and pharmaceutical colors. Corporate's operating loss was lower because of lower restructuring costs and was partially offset by higher performance-based compensation costs. They made less money from operating activities in 2024 compared to 2023. They make estimates for revenue recognition, goodwill valuation, income taxes, and inventories. It is important to see these listed so we know what could be fudged. They are exposed to currency exchange rates, commodity prices, and interest rates, but they try to manage these risks by using things like hedging. A 10% fluctuation in any of these key metrics could cause some damage. Here come the hard numbers. We are now going into the financial statements of the company. Net earnings were at $124.7 million, which translated to $2.94 per share. Treasury stock is shares that the company has repurchased. Goodwill is when a company buys another company and the purchase price is higher than what their assets are worth. Cash flow hedges adjustments is a special part of accounting that help with stability in net profits. They are making sure everything is safe and cyber secure. Our board of directors oversees cybersecurity risks with management. They are on it, making sure the company keeps up with the current technology. Alright, after that financial marathon, let's put it all together. Sensient seems to be in a good spot, but we need to keep an eye on a few things. One of their biggest challenges is keeping costs down. They're in a competitive business, so they need to be efficient to stay ahead. They might be buying or selling businesses to grow or focus on certain areas. These deals can be risky, but also rewarding if they pull them off. Cybersecurity is a must. A data breach could be a disaster, so they are investing in cybersecurity. While they've dodged any major cyber bullets so far, they know the threats are always evolving. They depend on the companies that use their products being successful at selling them to consumers. Their tax rate is pretty complex with lots of moving parts. Changes in tax laws could affect their earnings. ESG also matters now and has already resulted in regulations. If the company can't protect their proprietary formulas that could impact them as competitors may copy their trade secrets. The company has had fluctuations in the market, but they continue to innovate, which sets them up for success. The company's reliance on a global network of suppliers is beneficial for their international distribution. However, it is always a risk for disruption due to tariffs. Adjusted net earnings were at $127 million if there are no tax-related abnormalities. Operating their business in foreign jurisdictions presents global and economic risks. There have been some key personnel changes, and these changes may impact their business. Alright, so what's the verdict? Sensient seems like a solid company in a competitive industry. Their future success will depend on managing their risks and executing on their growth strategies. Based on their current earnings and growth potential, a reasonable price range for their stock would be between $70 and $80. But always do your own research before investing, and I am not responsible if you base it on my valuations here. Keep an eye on their debt levels and the global economy. They need to keep innovating and cutting costs to stay on top. Thanks for watching. If you found this breakdown helpful, please subscribe, like, and comment below.